Nokia stock is currently trading at $14.18 per share during regular market hours on Friday, May 22, 2026, marking a significant intraday upward swing of 4.11% as heavy volume floods the communication equipment sector. While the mainstream market is busy treating this as just another ordinary cyclical telecom bounce, the underlying reality is far more compelling because a major capital realignment is quietly taking place under the hood. Most retail investors tracking Nokia stock on standard investing sites assume that this classic Finnish corporate giant is simply riding the coattails of generic infrastructure spending. But the truth is that a massive supply bottleneck in artificial intelligence hardware has forced hyperscalers to completely rethink their data pipelines. By looking beyond the basic chart patterns on a typical individual brokerage account, we find that the explosive growth of high-performance computing has created a desperate need for efficient light-based data transmission, positioning this specific telecom player as a quiet backbone of the modern cloud facility. The conventional narrative suggests that old-school networking hardware providers are sluggish, low-margin operations destined to be left behind by fast-moving silicon designers. But smart money is realizing that chips cannot communicate with massive, highly optimized physical pipes. If you log into your preferred self-investing setup or check a premium service like Interactive Brokers Trading to see where large institutional orders are landing, you will notice a distinct pattern of accumulation that contradicts the common belief that this company is a relic of cell phone history. Let us build some common ground here, because if you talk to the average retail trader using a popular Robinhood stock trading setup, they probably still associate this name with indestructible plastic brick phones from 25 years ago, or think of it as a boring dividend payer that sits quietly in a long-term retirement account. The broad market expectation is that telecom equipment is a mature, low-growth industry where corporations slug it out over razor-thin margins while building basic wireless towers for global carriers. People looking for investment help often get told to focus strictly on hyper-growth technology software, leaving infrastructure companies cast aside as unglamorous. But the hard reality completely shatters this expectation because the current technical infrastructure layer is hit by a massive data wall, and the specialized fixed network architecture managed by this European legacy brand has suddenly become a critical dependency for massive computing clusters. Investors utilizing Interactive Brokers platform tools are starting to see that recent trading sessions are reflecting a completely unique profile, marked by high institutional buying volume that far outpaces historical averages. This massive accumulation isn't happening by accident. It is the direct result of large financial institutions waking up to a structural shift in how data centers handle localized traffic workloads. To understand why Nokia stock has experienced a staggering rise of over 120% since the beginning of the calendar year, reaching multi-year highs near its 52-week peak of $15.19, we have to look closely at the sudden surge in trading volumes and option market activity over the last few weeks. This massive momentum has been heavily accelerated by corporate decisions, including a major $4 billion investment commitment focused entirely on expanding infrastructure capabilities within the United States market. While the retail community was looking elsewhere, premium platforms like the Interactive Brokers platform and sophisticated individual brokerage accounts began logging unusual block trades, indicating that large funds were actively shifting assets away from overvalued software names and positioning themselves in physical hardware plays. This rapid price appreciation has completely blown past the consensus price targets originally set by Wall Street analysts, which had hovered much lower around $12.89, forcing major investment banks to scramble and issue sudden structural upgrades. For instance, analysts at major global banking institutions have had to quickly revise their ratings upward to a clear buy, acknowledging that their backward-looking financial modeling completely missed the specialized network demand curve. If you manage your personal capital through standard online investing tools, or utilize an automated system like Schwab Intelligent Portfolios, this dramatic shift highlights the critical importance of looking at structural reality rather than relying on outdated market reputations. The intraday action we are witnessing today is supported by massive institutional market depth, with trading volume tracking far above the standard daily averages, proving that this is not a short-lived retail meme trend, but a coordinated institutional migration. When looking closely at the active data, sector momentum has been highly favorable following blowout financial reports from major network infrastructure peers, which confirm that corporate capital expenditures on physical data pathways are scaling at an unprecedented rate. This macro tailwind has created a powerful halo effect across the entire communication equipment space, pulling this stock up with it as funds look for fundamentally sound companies trading at reasonable valuations relative to their actual cash generation. Even when broader technology indexes experience brief pullbacks due to macroeconomic pressures, such as fluctuating bond yields or global energy market uncertainties, the underlying demand for advanced data routing creates a firm price floor. Serious market participants executing orders through high-end investing sites are realizing that while software applications can change overnight, the physical fiber and optical routing systems required to transmit data remain an absolute physical necessity. Comment below how many shares of Nokia stock you currently hold, or if you prefer allocating your tech capital into speculative software instead. Let us pull back the curtain and look at what this business actually does today to understand how it supports its massive $72 billion market capitalization. Headquartered in Espoo, Finland, the modern corporation operates through highly distinct core business groups, primarily focusing on network infrastructure, mobile networks, and cloud and network services. Its business model relies on selling sophisticated hardware systems, software licenses, and long-term managed services to giant telecommunications operators, enterprise clients, and massive web-scale internet companies globally. A vital part of its financial health comes from its extensive patent portfolio, which holds tens of thousands of essential design patterns covering wireless communication standards, generating highly profitable licensing cash flows from consumer electronics manufacturers. Looking back at past performance reports from previous fiscal years, the company spent considerable time resolving internal supply chain issues and stabilizing its margins after the global rollout of early-generation wireless infrastructure proved to be highly competitive, capital-intensive. Older financial statements show a company that was heavily dependent on traditional carrier build-outs, which left it vulnerable to capital expenditure pauses whenever major wireless providers decided to slow down their hardware upgrades. This historical vulnerability explains why the stock spent years trading in a low, compressed single-digit range, frustrating long-term holders who were waiting for a clear catalyst to unlock the true value of its underlying engineering assets. This long-standing reliance on traditional carrier networks is precisely where the historical expectation diverges from our current reality, because the company has engineered an entirely unique business pivot that completely changes its financial trajectory. Instead of merely supplying standard cell towers to regional phone companies, the business has successfully directed its elite optical network division towards solving the complex data transmission problems faced by modern computing facilities. Recent performance metrics reveal that the company's cloud and advanced network systems experienced a spectacular sales surge of nearly 50% in the opening quarter of the year, a figure that caught the broader analytical community completely off guard. This explosive growth is driven by the rapid adoption of specialized network management services that utilize automated, localized logic to optimize data flows across complex corporate topologies without human intervention. By deploying these highly intelligent automated routing systems directly into their fixed network hardware, they allow data centers to maximize their existing capacity, reducing operational overhead while preventing costly network degradation. This specific capability caught the attention of premium chip designers, leading to a massive corporate partnership and a substantial $1 billion strategic investment in the telecom equipment provider. This move served as a massive validation for the stock, signaling to the entire financial world that the company's underlying technology is deemed absolutely vital by the leading edge of the hardware sector. For investors building a balanced portfolio through platforms like Fidelity Investments, evaluating these distinct fundamental layers is crucial when deciding between an automated robo-advisor or taking a self-investing approach. The classical view of this stock as a slow-moving, low-beta utility substitute is being replaced by a realization that it possesses an asymmetric risk-reward profile, combining a solid asset-backed valuation with explosive exposure to the computational build-out. Traditional investment help often emphasizes avoiding older hardware companies due to obsolescence risks, but this perspective overlooks the immense technical barriers to entry required to manufacture high-capacity optical transport networks. The specialized routers, switches, and optical transceivers developed by this firm require billions of dollars in continuous research and development, alongside highly complex global manufacturing structures that cannot be replicated by low-cost competitors overnight. This deep competitive moat ensures that as global data consumption continues its inexorable upward climb, the company remains positioned to capture highly predictable, recurring slice of infrastructure spending. Whether you are browsing options on a mobile app like the Robinhood app or conducting deep fundamental research through a comprehensive individual brokerage workspace, recognizing this deep structural shift is the key to identifying the wide gap between general public perception and institutional reality. As we look toward the horizon to map out potential future scenarios for Nokia stock, the interplay between expectations and reality will continue to dictate its ultimate valuation. In a highly bullish scenario, the company's expanding footprint in the North American enterprise market, combined with sustained high-margin licensing revenues from its massive patent catalog, could easily propel the stock past its recent multi-year highs to test entirely new technical resistance zones. The continued rollouts of advanced private network systems for massive industrial complexes, shipping ports, and automated factories represent a massive underpenetrated market that could sustain elevated revenue growth rates for multiple years. Conversely, a more cautious or bearish outlook must take into account real structural risks, such as potential delays in global carrier spending if macroeconomic conditions tighten significantly, or if regional court decisions create temporary headwinds for ongoing patent litigation. Furthermore, the integration of advanced automation systems into existing product lines faces fierce competition from nimble networking rivals, meaning that any execution missteps in their hardware delivery schedules could cause short-term margin compression. By continuously monitoring the balance between actual enterprise order flows and the broader market narrative across diverse online investing platforms, serious investors can successfully navigate these complex cycles. To wrap everything up neatly, the central insight driving the action behind Nokia stock today is the massive structural disconnect between its legacy reputation as a sluggish telecom hardware provider and its current reality as a vital physical foundation for high-throughput computing networks. The broad market expected a slow, predictable, cyclical recovery, but the reality delivered an incredibly aggressive high-margin expansion into advanced data center switching and automated optical infrastructure, heavily validated by premium hardware partnerships and massive strategic investments. This clear divergence between public expectation and fundamental corporate execution is precisely what has fueled the stock's magnificent three-digit market run over the past several months, catching short sellers and conservative analysts completely by surprise. While temporary pullbacks are always a natural part of any major market expansion, the high-volume institutional accumulation observed across elite trading platforms suggests that the long-term structural investment thesis remains incredibly robust. For anyone managing their own capital through a personal individual brokerage account, monitoring these core physical infrastructure constraints will provide a far deeper, more authoritative understanding of the technology sector than simply chasing overhyped software trends.